Hello and welcome to a brand new episode of ET Worldview where we discuss everything related to world markets, trends, and much more. I'm your host Neha Vashisht Mahajan, and like every week, I have Mr. Abhishek Banerjee with me. He's the CEO and founder of Lotus Dew Wealth, which is a SEBI registered RIA that gives stock basket recommendations combining macroeconomic analysis with micro cap stock selection. Thank you so much, Mr. Abhishek, for joining us today on ET Markets live stream.
Thank you very much and glad to be here.
So let's quickly start our session for today and let's start with France. So, France is a key EU country and has been in the news for a surprising uptick in consumer spending, even though inflation remains high at 2.5%. What should investors be wary of in the EU, which is a sluggish investment destination?
You has always been considered as a slow destination, right? So
Hmm.
things happen very slowly in Europe. Um, I have lived in Europe for many years, and inflation of 2.5% really is a big problem because
Hmm.
the incomes don't grow that much in Europe because
Hmm.
the hikes in salaries are typically in the range of 1 to 3% per year, usually, right, for normal jobs, the daily jobs. So uh, for somebody to accept a 2.5% inflation, they basically have to cut down on things that they could have done before if they didn't get the requisite hike in wages. Uh, what we are seeing here in Europe, especially in France, as you're aware, like
Hmm.
France is up for re-election, and there's election, season going on. So usually in the election season, inflation and consumer spending do go up, and
Hmm.
this is what we are seeing. But it's a phenomenon that is cyclical to Europe. Around the same time, a lot of changes are expected. We know
Hmm.
that, for example, the far right in France, the far right obviously means the most conservative political party who wants to block immigration, who wants to get more productivity out of labor. So these kind
Yeah.
of people are getting more prominence in the current election phase, and the same kind of sentiment is shared across multiple. For example, in Spain, the unemployment is pretty high, around 8-9% compared to other European countries. So Europe as a general, there are some structural changes that is happening. It's been sluggish. They are dragged into the conflict because of their neighboring borders with Ukraine. So,
Hmm.
from that standpoint, I think usually when such early signs of kind of breakout happens, there'll be conflicting indicators, right? So some indicators
Hmm.
will be positive, some indicators will be negative, and you have to make sense, which side you belong to, right? And that is the key as a macroeconomic researcher. When you're looking at macroeconomic trends, not all indicators will point to the same direction. Then it's very obvious. You have to
Hmm.
make a decision before that happens.
Hmm.
So it seems that Europe is definitely going to be an interesting investment destination. There are a few Indian mutual funds that, for example, invest in Europe specifically. It could be a
Hmm.
way for investors to have a look at their allocation, overall global asset allocation.
All right. Talking a little bit more about Europe, the KOF indicator from Switzerland predicts an uptrend in the economy. So we have positive signals coming in from Swiss and the France, and there is a little bit of expectations of recovery of global GDP, EU-led recovery actually, especially when it comes to the recession in the UK. So what do you want to add to that?
Yeah, I think so Swiss. I remember Swiss franc versus Australian dollar is a classic bull bear trade, where
Hmm.
Swiss franc is a proxy of gold and Australian dollar is a proxy of commodity and inflation, and people have
Hmm.
been using this as a proxy to trade. Uh, Uptick in Swiss economy, where Swiss economy is again like a slow moving conservative economy, basically driven by tourism, right?
Hmm.
So an uptick there is a very good sign for overall region because it takes a lot for a country as stable as Switzerland to grow, right? And because
Hmm.
everybody has is growth from in developed markets comes from immigration because new people come in, they buy houses, they buy furniture, they buy clothes. That's where the growth is.
Hmm.
So people who have lived there for long enough, neither your car gets spoiled because the roads are great, so you don't need to buy a car every 5 years, 10 years. So the
Hmm.
consumption pattern is mainly driven by immigrants, and immigrants again are also a hotspot politically, where there is sentiment against that. So obviously, for somebody who is educated and understands the link, they will prefer immigration. But for an average person who perceives that the jobs that they could have done goes away to somebody else, that's not a great,
Hmm.
political stance. So in this context, I think Europe's still pretty good compared to other developing nations in terms of immigration versus, for example, Japan.
Hmm.
If you want to work in Japan, it's quite hard. Or South Korea or things like that. But overall, I think, my read is that we have to watch out. But it looks like it's a good starting point for a long-term investor in Europe.
All right. Coming back to India, India's bank loan growth is at 19%, and the deposit growth is only 12%. Do you think that this disparity indicate a need to raise interest rates so that to get more deposits? And I also want to understand how these two metrics are related to each other.
So let me explain this, how banking basically works. In banking, you have SLR and CRR, so a standard liquidity ratio and the reserve ratio. So what that means is, for let's say 100 rupees of capital, RBI says that when you get 100 rupee deposit, you can lend out 100 minus the CRR SLR kind of limit. So typically in Indian banks, you will see this at around 15 to 12%, depending on the liquidity position of the bank.
Hmm.
So 15% is blocked, and the remaining 85% is given out as loan. Now the person who gets the loan again goes back and deposits in the bank, some other bank, right? It's basically, therefore it is a circular system where you get multiple operating, you typically banks, the money supply is levered few tens of times, right? Because you get the money and the receiver also puts it back in the banking system, and then the banking system lends that part out and puts it back in the. So if you divide 100 by 15, you automatically, let's say, if there was only 100 rupees in the whole banking system and this rotated, you would be able to lend out the same money almost like 6 times, right? So but typically banks are able to do it more than kind of 30 times in some cases, US banks. So what this means is that we if there's a huge disparity in the loan growth and the
Hmm.
deposit growth, eventually the cost of capital will keep rising because they have to attract new deposits to
Yeah.
kind of replenish this cycle. And what is also happening is that as Indian consumers become more aware financially and they become more financially literate, that means
Hmm.
that they will go and invest in markets instead of using risk-free fixed deposit. The ability to attract deposits is also reducing. So we have to watch out for the fact that people who are exiting fixed deposit to go into markets are actually bringing the cost of capital up for everybody, including the markets, in the markets that they're kind of investing. So it's really the growth of depositors that really drive this, and it's
Hmm.
linked in that sense.
All right. So before we move to the US part, and I also want to talk about PMI, Chicago PMI as well. I also want to talk about Indian markets right now. So we've been seeing Indian markets going up and up in the last 2 3 weeks. Yesterday also, Sensex touched the 80,000 mark. I want to understand, these are obviously all time highs. I want to understand how can investors look at markets at this point.
So typically when there is a start of a bull cycle, all-time highs get taken out on a weekly basis, right? Every week there'll be all-time high, and there'll be
Hmm.
people sitting sidelines waiting for a correction can happen, like 10%, 15% in a market
Yeah.
like India is possible anytime. Usually it will be led by some sort of a climatic event, or a international event, or a
Hmm.
border event, or a kind of a scam kind of event. Or so these triggers usually are something to watch out for. What we need to understand is that in spite of two wars that's actually going on, the Ukraine war and the Israel war, in spite of the fact that European demand was sluggish for the last few years, in spite of the confused, electorate in US and their policy direction, in spite of, like, Japan not being able to come out of, into a growth space, India has done pretty well. And of course, the sanctions from Russia, which means some things cannot be bought from Russia and sent to Russia. So
Hmm.
this is happening in spite of that, right? And tensions over a period of time will only decrease, they never increase, right? I mean,
Hmm.
a lot of people work very hard to diffuse tensions. So tensions will overall decrease, volatility will overall decrease, and therefore, to me at least, it seems there's so many good things that are out there which India can do in the near future. Even at these levels, I feel that for a long term investor, there's a lot of juice left.
All right. Uh, let's move to Chicago PMI. So the Chicago PMI for the US exceeded expectations, and the Chile reported a 10% increase in copper output. US construction spending has decreased, has contracted, and US election is also around the corner. How should these mixed signals be interpreted?
Yeah, no, I am glad that you pointed out like very different kind of indicators. So copper is a proxy for construction, but the construction spend has decreased, right? So
Hmm.
because copper is used in electricals, in equipment used for construction, and so on. So it is very, kind of, a lot of signals are crisscrossing each other, and it's a bit confusing. And therefore, usually this happens at the start of an inflection point. And my worry is that it could be the start of an inflection point downwards for US recession, because remember, the bond yield has been negative slope for a very long time and without a recession actually happening. So I'm
Hmm.
actually more concerned about that aspect. For us, it's a kind of a important thing as well, because when recession hits US, Fed will be required to lower the interest rate. When they lower the interest rate, the dollar will weaken. If the dollar weakens, we get less rupees for our IT exports. When that happens, we have less revenue coming into IT
Hmm.
services. So um, we might get more jobs in because of cost cutting due to recessionary pressures in US. But the for the existing kind of billing cycle, we are directly linked to the trajectory of the US dollar for most IT services, pharma companies, for example, as well. Any kind
Hmm.
of services, large bouquet of services. So we, that is something for us to watch out for. And if that were to materialize, then there's still like Fed cuts expected, at least one. If that accelerates to two, three in the next 6 months, then that will further put pressure on IT services, because they, unless they expand the base, right, where they get more jobs
Hmm.
because of job cuts in US or other more expensive locations. Uh, if that were not to happen, it's only the same jobs but less dollar revenue, then it's a problem.
All right. And do you think that declining mortgage applications and car registrations in the US also suggests economic turn down in terms of a recessionary cycle? Do you think that this signals at recession in the US?
Yeah, that could be. For example, uh, there is a lot of inventory of housing is very tight, which means there's not a lot of inventory that's available, which means rents are
Hmm.
going up, which means inflation is going up in US. But construction is output is negative.
Hmm.
Mortgage applications have is a downward trajectory. And cars, people are crazy about cars in US, because everywhere, and it's very cheap and good growth. So cars is a very good sentiment indicator of direction of market. So to my mind, it seems that we have to be very very careful in closely watching US indicators for the next couple of months to anticipate any recessionary pressures. But to my mind, it is happening.
All right. So let's quickly jump to the questions from the audience and then we'll close our session for today. The first query I'm picking is by Abhijit. He's asking, is this the right time to align to stock specific strategies?
I mean, you mean single stocks to pick? I'm not sure what that question means, but I'll take
Hmm.
a guess that it means like a basket of stocks or a sector
Instead of
specific.
sectors.
Huh.
Yeah, yeah.
Yeah, I mean,
Because right now the markets are the rally that we see in the markets are mainly broad based and mainly due to blue chips. So I think the question is related to that, that investors should go separately for probably sector wise or mid cap or small cap.
Yeah, I mean, see, there are 5,000 listed companies almost in India, and out of
Hmm.
that, about 1,200 have institutional buying, which means 1,200 are invested by some mutual fund or some, PMS AIF like that. So uh, that 1,200 bucket, right, is still very large, right? From there, you got to pick like 25 to 30 companies to run a good concentrated portfolio. So India has always been a stock pickers market, right? If you're a good stock picker, you should always go for that. But in even in mutual fund category, you have the focused fund category where they pick 25 stocks in multi-cap, which is a very good cheap way of getting PMS like exposure, for a broad market exposure. So I think, stock specific, yes, depending on the amount and your expertise, choose the right vehicle.
Hmm.
Whether you are doing it, or you're buying a basket of equity, or you're buying a mutual fund. So depending on your understanding of the market and your ability to find such picks, definitely.
All right. And do you think that this is the right time in the markets to invest as lump sum, or should investors go for staggered type of investments like
So
SIPs?
yeah, I mean, SIP is always a better option because it allows you to average out prices. Uh,
Hmm.
the way I at least, tell my clients to think about it is that, if it's a lump sum, and you have want to use that lump sum for less than 5 years, then you have to depend on luck.
Hmm.
You can get lucky that your money doubles in a year, but in
Hmm.
equity markets, but it's luck, it's not skill. So anything less than 5 years, in terms of investment horizon, you should
Hmm.
avoid lump sum. First point. Second point is that how critical is this money for you, right? People always overestimate their risk profile. They feel that they
Hmm.
can take a more risk than they can actually take. So when it gets really bad and negative returns in the market, whether you have the stomach to see your money drop by 50% when you have invested lump
Hmm.
sum in 3 months, is something for you to really consider when you're investing. But for me, whenever I have extra cash, I put it in markets, and it's always long term, it's always lump sum. So for me, it's personally, I feel that I have SIPs in mutual funds, but for investing in stocks, I think usually these are long term picks. So I put it in lump sum.
All right. One last query I'm picking is by Varun. I'm not picking any stock specific question. We have a question on railway stocks as well. Uh, would you like to take that, or should we skip?
I mean, I think we
The
can talk about
question is,
railways,
yeah, the
railways in general.
question is views on railway stocks for fresh buy at this point.
I still a broad buy. I think generally, because don't be worried about the run up, because there's a lot that can happen even now, and lot has to go wrong. So the main concern is like order book to revenue pipeline, right? So they have large amount of orders. There is a incumbents will get orders, but will they be able to execute on that order, right? And that so far they
Hmm.
have done a great job. So I am not very. It's just the demand was never there, right? India never had the money to buy so many railway carriages for its people. And if
Yeah.
we are doing well in tax collection, if we are able to raise external capital, the demand generation is not a problem. There's always demand for such services, metros in different cities,
Hmm.
fast trains. So the demand is there. It's just our ability to fund that demand, has improved a lot.
Yeah. One last query I'm picking is by Varun. He's asking, what do you think about pharma sector in India right now?
I think overall it's a we are very positive about that sector, and it's a choice between IT services and pharma for us always, because we think of them both as sort of contract services manufacturing kind of place. So pharma companies have a lot of cheaper labor, and then some very expensive, like heads and then research and so on. So
Hmm.
operating leverage in a pharma company is way higher than in a IT services
IT.
company. Of course, there also you have multiple ranks of people who are getting different kinds of salaries, but point is that that spread is way wider in a pharma company compared to a IT services
Hmm.
company. So in that context, what really matters is your ability to take absorb fluctuations on US dollar while you're not able to adjust your cost structure. So pharma companies are better suited for that compared to a IT services company.
All right. So we're done with the queries from the audience. And with that, we have reached the end of our segment as well. Thank you so much, Mr. Abhishek, for joining us today on ET Markets live stream only on ET Worldview.
Thank you very much for the opportunity. Glad to be here.
Thank you. Thank you, everyone, for joining in.